Good evening and welcome to the 8th edition of our Quarterly Connect webinar. As always, thank you so much for taking the time to attend this evening. We continue to build our businesses both in India as well as globally. Our AUM at a firm-wide level now stands close to 48,000 crores, of which about half of this AUM has been contributed by individual investors, high net worth and ultra high net worth investors. We thank all our investors for trusting us to manage your wealth and all our distribution partners for the support extended to us. This evening, we'll start off with a session from Prashant, our founder, who will provide us an update on the firm, the funds, and the performance of our PMS. This will be followed with a deep dive on the emerging opportunities in the consumer discretionary sector, presented by Rohit Chotia, Director and a senior member of our investment team. At the end, we'll have a Q&A session with Prashant, Rohit, and Parag. I request you to kindly post your questions in the chat box at the bottom of your screens. Over to you, Prashant.
Thank you, Vivek. I hope everyone's able to hear me loud and clear. Rohit, raise your hand if you're able to hear me. Great. So we can go straight away to slide 20 to talk about performance. So as you can see, this is a performance since a table on the left shows performance since inception for the PMS strategy, which was about 3.5 years ago in April 2019. The top row shows that last quarter was a fairly good quarter for the market. Market up, BSE 500 up 11.3%. Our team did quite well as well, up 13.8% for an outperformance of 244 basis points. However, year to date has been challenging. We've discussed earlier as well. And despite the outperformance of the quarter, year to date, we're still trailing the benchmark by 836 basis points. Black mark, if you will, on otherwise a perfect scorecard. As you can see in the prior years, every year the team has generated solid alpha, and since inception remains a very strong alpha generation track record with a CAGR of 19% compared to 15.8 of the benchmark, and cumulatively 86% net compared to 68.7 for 1700 odd basis points of alpha. We go to next slide, just some performance attribution on since inception basis, and we'll come to year to date as well in a few minutes, but just more importantly, sharing the since inception numbers. You'll see on the table on the right, gross of fee, these are gross of fee analysis now, 92% return. You'll see at the bottom of the second column, 92% return compared to 62. So 30% alpha, as you'll see in the bottom right-hand side box, of which 39% has come from stock selection, which is positive across each market cap segment, whereas market cap attribution has been -9%. The same can be viewed more graphically on the left-hand side chart, where the mid-cap sector delivered the highest alpha, all of it driven by stock selection, but large and small cap also delivered good alpha driven by stock selection. Next slide, if we go to, this is the sectoral attribution since inception. Same thing, you look at the bottom right-hand side table, the right-hand side table at the bottom row, 92% return of the portfolio, 62 benchmark, 30% overall outperformance, of which 32 has come from stock selection. Since inception, -2 has been the sectoral allocation effect. And on the left side, again, you'll see graphically, utilities has been the biggest detractor to the tune of 4.5% from a sectoral perspective, whereas on a stock selection basis, several sectors have contributed very handsomely, and most of them are positive. If we go to next slide, then this shows the top contributors and detractors from an individual name perspective. On the left side are the top contributors. You'll see Naveen Fluorine, Coforge, and so on. What's good to see is a very good distribution of contributors, which basically suggests that the law of large numbers is well at work. Performance has not been driven by one-off big hit, which may or may not be repeatable. So when you have a more granular contribution to performance, that's certainly more comforting. as it may be more attributable to skill rather than luck. On the left-hand side, sorry, on the right-hand side, similarly, the detractors also are reasonably well distributed. So the team's done a good job at position sizing and risk management, not allowing any single stock to draw a big hole in the performance. So you can see top 7 contributors are larger than the top detractor on the 2 tables, as you can see. Going to the next slide now, talking about more the quarter first. Here you'll see in the bottom row 14.5 compared to 11. So 3.2% gross alpha, mostly driven by stock selection, which is 2.9%. Yeah, a lot of it coming from large cap. Next slide, if you see. Now, a quarter is a very short time period, so not a whole lot of conclusion to be drawn from such attribution analysis for a quarter. Typically, these attribution analyses are most useful when done on a multi-year time frame, like at least 3 years or 5 years or even longer. But we're just sharing it so as to know just the facts. Not a lot of inference can be drawn, but just to show the facts. Here on the sectoral attribution perspective also, you'll see out of 3.2, 2% of alpha came from stock selection. Allocation effect was also 1.2. Most of the allocation effect was from the energy sector, as we don't own any Reliance, and Reliance Industries did, I suppose, underperformed in the last quarter, contributing to the sectoral outperformance. Next slide, please. These are the top contributors and detractors to performance. Left-hand side, you'll see the top contributors, Ambuja Cements, which obviously got acquired by the Adani Group and did very well since the close of the tender offer. But other names also like Titan, Estral, and so on contributed handsomely. Some of these have been long-standing positions in the portfolio. Others, like Ambuja, were added more recently at the time of the acquisition announcement. The right-hand side table shows the detractors continuing somewhat the trend of the year-to-date numbers, including the prior 6 months. The IT services names appear quite prominently, 4 of the 5, given the problems with global demands or worries about global demand slowdown, the fact that NASDAQ's been beaten up, down more than 30%, at least as of the end of the quarter, if I'm not mistaken. That contributed also to the underperformance of these names in the portfolio. Next slide. If we go to, this is more, a lot of analysis, I know, but might go through very quickly. This is attribution on a year-to-date basis, which has been negative. So you'll see on a market cap attribution perspective, minus 6.2% overall negative alpha on a gross basis, of which minus 5.5 is from stock selection, most of it coming from negative hit from mid cap. So in the since inception numbers, you saw mid caps were the biggest contributor to alpha. And that was even after including the year-to-date numbers, right? Because since inception include year-to-date numbers. But yes, year-to-date mid-cap segment, particularly the mid-cap IT names, which you saw on the previous, or you'll see in the later slide, the mid-cap IT names, which have since inception contributed quite handsomely to our performance, have hurt on a year-to-date basis. If we go to next slide, what's also hurt on a beyond mid-caps is the overall sector allocation. You'll see nearly half, or more than 40%, close to 45% of the negative alpha this year, as you can see from the bottom on the green columns, is due to allocation effect, where utilities have been on a rage, and they've contributed minus 1.4%, and IT services, which we were overweight, has contributed negative 1%. So these two predominantly have contributed to the minus 2.7 of negative alpha in the allocation effect. Next slide, please. Here are the names that have contributed positively year-to-date basis, led by Cholamandalam Finance, and the other names you can see quite a few of them common with, or 3 of them common with the last quarter's results. And on the right-hand side, you'll see top three names in terms of negative contribution, adding up to over 300 basis points, were from the IT services pack. Next slide, please. Now, so we've talked about performance from a numerical perspective relative to the benchmark, market cap attribution, sectoral attribution. We also, during the last two calls, if I'm not mistaken, gone through the reasons for underperformance. What are the causes? And we've talked about under allocation to sectors like utilities, commodities, PSUs, which don't come out clearly through these standard attribution analysis, but we historically have hardly ever owned PSUs, or hardly ever owned utilities or commodities or energy. And those are the sectors on fire this year, if you will. Some of the top performing names, if we were to quickly go to that slide, Dipojal, have been from the top performing names have been from the those sectors. As you can see here on the right-hand side, left-hand side table, Adani Power, Adani Enterprises, Adani Total, and Adani Transmission, and Adani Green Energy. 5 of them from utilities. Sorry, these 5 names. One of them is mentioned as industrials, Adani Enterprises, because it's a holding company, but effectively it owns all these utilities, and bulk of the value is driven by these utilities. So 5 out of the top 10 names are utilities, and all happen to be Adani Group companies, which we haven't owned and are large positions in the relatively large position in the benchmark. Then there are SOEs like Hindustan Aeronautics, Bank of Baroda, which we not own. I'm not saying right or wrong, but I'm just saying historically we've never owned these segments. Whereas sectors like consumer discretionary and private sector banks, which tend to usually be always overweight, particularly consumer discretionary has not done that well this year. And IT services this year was a considerable overweight, and that has been hurt. As you can see on the right-hand side, 7 out of the 10 names are IT services. Now, if we go back to, so this, I'm not going into too much details because it would be repetitive for a lot of you who joined us on prior calls. What we are going to do is look at peer group performance. So, earlier during this last 12 months, the team has won several awards, and we'll point those out in a couple of slides for top ranking performance over the last 3 years, 5 years, or even somewhat shorter time horizon, but more than a year. So it is somewhat of a dichotomy where the performance against the benchmark is the worst that we've ever had, and yet we are winning awards at a higher pace or larger number of awards than almost any other time that I can recollect in my 15-year track record. And this next few, and some of you might have noticed my LinkedIn posts congratulating the team and thanking investors on the achievement of these long-term awards. But so this would throw some light on this dichotomy. So what you see here, what the bar graph shows, is for each of the years you mentioned here on the x-axis since our inception at WhiteOak. Now, let me just caveat a footnote here, which is that obviously our PMS started in 2019, but we as a team started managing external money since August 30th or September 1st, 2017. So prior to April 2019, this analysis has used other representative portfolios like the AIF we've had, and before that, even the India Econ Fund, which is foreign money that we managed for a few months before the AIF track record is there. So all that footnote and caveats, what this is the performance of the WhiteOak team compared to the PMS peer group. And we've taken for this slide 24 data points. So every PMS scheme that has more than 1,000 crores, and Dipojal, correct me if I'm mistaken, but every PMS scheme that is multi-cap and has more than 1,000 crores of AUM, we've taken that. And what the bar represents, the green in the bar represents top quartile managers. The light blue, sky blue represents second quartile. The beigeish color is the third quartile, and the red is the fourth quartile. The yellow box in the middle is the benchmark performance. I assume everyone is familiar with what the quartiles mean. Top quartile is the top 25% by performance of the manager, and bottom quartile is bottom 25%, and so on, right? And the dark blue bar or line that is there, that represents our performance. Yeah. So even if you eyeball the graph, you'll see most of the years we are above or well above the benchmark and well above most of the peer group. This year, the benchmark is high up. And if you see on the right-hand side, on a 3-year and a 5-year basis, we are well above the benchmark again. And on a 5-year since inception basis, we are pretty much at the top, maybe second from this graph of more than 1,000 crores, right? And the table below, you'll see for each of these years, partial or full years, the performance of WhiteOak compared to the benchmark and the alpha generated. Very solid alpha, something that you saw in the tabular format earlier as well for the PMS strategy, and similar yearly over here mentioned. On a year-to-date basis, minus 835. On a 3-year and 5-year basis, still very solid alpha compared to the benchmark, obviously lower than our longer-term averages, but yet very solid when compared to peer group. If you see in the next slide, that would become more evident. So last 3 years have been a time period where benchmark itself has done quite well. What you see here in this table is out of the previous batch of 24 managers, what we've including the benchmark, what we've done is selected the 10, because it's 10 is just, otherwise the data becomes too difficult to follow or talk about. Here, WhiteOak and the rank ordering is, obviously we've hidden the names of the peers, but these are the top 10 or excluding the benchmark, top 9 PMS fund managers or fund schemes by AUM. All of them are above 2,000 crores. And you know, basically there are no other, besides this, there are no other multi-cap portfolios over 2,000 crores. So we've included everyone that is more than 2,000 crores, which is 9 PMS schemes for multi-cap. And we've added the benchmark here as well, S&P BSE 500. And then we look at, it's the same data, underlying data as the previous chart, but presented with the underlying numbers as well, and a little bit more data. So you'll see the WhiteOak strategy. Obviously, the darker the shade of blue, the stronger the performance, and the darker the shade of red, the weaker the performance. And the assortment is done basis the best performance over a 5-year period or since inception. So you look at the rightmost column, you'll see WhiteOak is at the top, as I was saying in the previous slide, at 19% compounded return over a 5-year or little over 5-year time period since September 2017, at 19% return. The second best is 17.1. The third best PMS is 14.2. So it drops quite dramatically between the first and the third. The difference is nearly 500 basis points compounded annualized. And then the benchmark itself is 13.8% over this time. On a 3-year basis, we are second best performing at 20.7% return. You'll notice that on a 3-year basis, interestingly, the 10th best manager from a 5-year basis is the best performing manager on a 3-year basis. So some managers can have a very volatile return series, which is the case with the bottom ranking manager, because if you see in 2017 the manager was second best performing. Then in 2018 and 19, both years were worst performing. And then 2021 was the best performing, and so on and so forth. So 3-year is best, but 5-year is worst performance for that manager. So I hope this is data that is not too confusing to look at, because there are a lot of numbers. But if you either look at the numbers or look at the shades of blue and red, and you'll figure that who has performed how, get a picture of how someone has performed. You'll see on a year-to-date basis, which is third column from the right, the benchmark is the best performing at 4.6%. Okay, the second best performing is 1.4%. All right, so in a way, the best performing manager of these top 10 is behind the benchmark by 320 basis points as of September end. So it has been a year where benchmark has left everyone behind. If you go to next slide, this is again same underlying data presented in a graphical format without the numbers and with a color coding, which might be helpful to see how over time these top 10 managers or 9 managers plus the benchmark have moved in their ranking from year to year. And then where is their ranking in 3-year and over since inception of 5-year, which I've mentioned earlier, but this is like in a way summarizing. So WhiteOak, obviously we've chosen the color to make it stand out, but the dark blue color is that of WhiteOak. So in 2017, which is only 4 months, but we were best performing of these 10. 2018, we were second best performing. And the white one is the benchmark. So you can see where we are relative to benchmark. In 2019, which actually compared to the peer group was our worst year, because you'll see 2019 till now is the only year when, amongst the top 10 managers, there were more managers who outperformed compared to us versus underperformed compared to us. Though we still outperformed the benchmark that year, but there were 5 managers who outperformed us amongst these top 10 compared to 3 that underperformed us. And then 2020, we were again the best. 2021, we were the third best out of this group. Now 2022, we are middle of the pack compared to the peer group. The benchmark is, as you can see, the best performing. There are 4 managers ahead of us from the top 10 and 4 managers behind us. We are middle of the pack. So fairly strong and fairly high degree of consistency in our performance, most of the time above the median. Yeah. And on a combined 3-year basis, we are second best. The benchmark itself is third best. So it's been very difficult over the last 3 years. Very few managers, in fact, as this shows, only 2 out of the top 10 have outperformed the benchmark for a trailing 3-year basis. And on a since inception, which is a 5-year basis, we, as the prior slide also showed, we are top ranking, and benchmark is more or less middle of the pack, but slightly better than the middle, where 4 managers have outperformed and 5 have underperformed. As again, you can see portfolio number 8 or fund manager number 8 was in top ranking in a 3-year basis, but bottom of the pack on a 5-year basis. So a lot of information to digest, but I thought rather than presenting performance analysis in the same fashion as we did the prior 2 quarterly webinars, we'll present it in a different form so that you get a perspective of what's the landscape, how various players, if you will, are playing this year and over the trailing several time periods as we spoke about. And next slide, if we go to this relative peer group, because when you get an award, it's like when you win the World Cup, which unfortunately India is out of, but when you win the World Cup, it's not on the basis of how many runs you score in absolute, but it's on the basis of whether you scored more than your opposition. Yeah, you can score 200 runs and yet lose it. You can score 100 runs and yet win it in the T20. So the awards we won, these are all the awards that we won year to date or the last 12 months. As I was saying, this is greater frequency of winning awards than any other year in my nearly 16-year career. Most recently, last week, we won a very prestigious CityWire. CityWire is one of the, if not the most well-known publication in Europe. So a lot of these awards are from global agencies or global institutions, just because there are many more of those outside India. In India, we don't have so many publications or agencies or otherwise institutions who are creating these awards. So November 2022, we had Ashoka India Equity, our UK listed trust, win the Best Emerging Markets Single Country Award just last year. This is for a 3-year performance record. Not only were we ahead of any other Indian manager in the universe, but also ahead of any other single country, be it China, Vietnam, Brazil, or anyone else. Ashoka India Opportunities Fund, our UCITS fund, earlier in the year, mid-year, won the Best Investment Week Fund Manager of the Award. And then, Lipper Awards are extremely, all these are highly reputed awards. And Lipper is universally, not just in Europe or institutional market, which is what the Investment Week is more focused on, but universally Lipper is very well recognized award, and many of you on the call might have heard about it. And we won the Lipper Award for the best fund in the India equity funds category out of 40 India funds for a 3-year period. And similarly, earlier in the year, we won in India. In February, we won the PMS AIF World Award for the best PMS on a 2-year performance in the multi-cap category. And finally, in November 21, we won the HFM Asia Performance Award for the best UCITS funds. Again, we also won, I think we're missing one over here. I recollect we also won within the last 12 months, I believe, the Morningstar award, or it was possibly just the 5-star rating and not an award of sorts. So I take that back. But these are 5 awards over the last 12 months. And this is basically because compared to the peer group, our team has done a has delivered very strong performance over the last 3 years, 5 years, or even on a year-to-date basis. While it is far behind the benchmark, but on a peer group basis, as we saw, is disappointing that it is middle of the pack. But given the stronger performance last year and the year before, still ranks in the top performing managers. So I'll pause here and turn it over to Rohit to discuss consumer opportunities in consumer discretionary space.
Good evening, everyone. Season's greetings, and thank you, Prashant. Here to talk about emerging opportunities in the consumer discretionary space. Now, consumer discretionary is something that's very close to all of us. It's a sector which is all about living a good life, feeling good, eating good, right? And in some sense also a signaling of how well we are doing in life, right? So it's a sector which is exciting, something we can all connect very well to. And we strongly believe that India is at the cusp of a multi-decade growth in some of the consumer discretionary categories, and that makes it very, very exciting and interesting for us as investors who believe in bottom-up stock selection. And I'll talk through some of these things in the Indian context over the next few slides and the next few minutes, right? So if you could move to the next one, Deepaji. Well, let me just start with the looking at world's most valuable companies, right? We've just picked the top 50, and the ones shaded in green, right, are either what are names that are traditionally thought of as consumer discretionary companies, right, directly, or can be argued to be consumer discretionary companies. If you look at the top name there, Apple, right? Is it a tech company, or is it really a tech, a consumer discretionary company that has a tech product, right? If you look at the lines outside Apple stores when a new iPhone is launched, right? It's really consumer discretionary, right? What they produce is a tech product, a marvelous piece of gadgetry, but at the end of the day, it is a consumer discretionary play, right? And if you go through the names, right, you'll find various shades of consumer discretionary. Some, as I said, directly consumer discretionary, and some which one can argue are really consumer discretionary plays, right? So close to 45% of the top 50 names. Around 22 of these names, right, can be linked to or can be argued to be consumer discretionary names. The other important point I wanted to make on this slide was that you will see a very diverse set of subsectors or subcategories, if you will, right? Apple is a tech company. You look at Amazon, it's an e-commerce company. Tesla is an auto company. Visa is a payment, behemoth. You look at Walmart, it's really the largest brick and mortar retailer in the world, right? P&G is really a CPG company now, again, partly consumer staples, but some of their portfolio is consumer discretionary. LVMH is a luxury goods company. Tencent is a gaming company, right? And if you go through the list, you'll find, representations from the alcobev space, something like, Quechao Mota in China, the largest alcobev company in China. Home Depot is really a home improvement company, right? A retailer, the largest home improvement retailer in the world with close to $155 billion in sales, right? Samsung, again, electronics. So you go through the list, you have an entertainment company in Walt Disney, a food services company in McDonald's. So it's a sector with a very rich diversity. It touches, all aspects of a household's or a consumer's life, right? And that this is what makes it extremely interesting and extremely challenging at the same time. We can move to the next one, please. Now, just to sort of differentiate between these two terms that you'll hear, right? Staples and discretionary, what, differentiates a category. Now, there's a fine line, as I also, say on the slide, that one man's staple can be another man's discretionary, right? What was discretionary for a particular household or a consumer 10 years back is probably has become a staple. I mean, do we think of smartphones as a staple category or a discretionary category today? For a good section of the population, it has become a staple. You can't live without it. Forget for a day, maybe even for an hour, right? I remember, when one of my phones broke down, I got a new one within an hour. So it's as staple as it gets, right? And that's the fine line we are talking about. But just to still differentiate between staples and discretionary, I've just put some attributes together. Right? The basic consumption driver of a staple category is really need. While when it comes to discretionary categories, it is more towards the want, desire, and aspiration end of the spectrum, right? From a shopping experience perspective, right? Staples is a low involvement to medium involvement category, while the consumer involvement when it comes to discretionary categories tends to be very, very high. That also extends to, how personalized are these categories, right? Staples category is very, very narrow. While when it comes to discretionary, there is scope for very deep, very wide personalization, right? Think of premiumization potential, right? Staples, let's take a category, let's take soaps, right? If you take a standard 100-gram bar of soap, the range of soaps available in the market, if I look at 99% of value in the market, it'll be between 20 rupees to 100 rupees, right? So it's a 5x. Now think of ladies' handbags or shoes, right? Sports shoes or sneakers available in the market. You can get a sneaker for 200 rupees, and at the top end, right, it can go as high as 20,000, even if you take the outliers out, right? So discretionary categories also tend to have a very fat tail on the right side, right? And a significant part of value coming from, premium products, right? And again, because this is a play on desires and aspirations, this premiumization journey can actually be unlimited in a way, right? And hence you see names like LVMH and Hermes, right? These names which have created significant wealth, these are all premium plays, right? Now coming to the impact of this on financials, right? What you see in terms of ROC range in these sectors, right? In staples, it tends to be a fairly narrow range. When it comes to discretionary, with a couple of outliers, right? But otherwise a very tight band. But in discretionary categories, this can be extremely wide, right? And lastly, leverage to disposable income growth. When disposable income grows in a country or an economy, staples have a low leverage to it, while discretionary categories tend to have a significantly higher multiplier, right? Which makes it very interesting in a fast-growing economy, which we all expect India to be, right, for many, many years to come. And what all of this leads to, from an investment standpoint, is that the value creation skew between companies tends to be low to medium when it comes to consumer staples, but extremely high when it comes to discretionary. And what that means for bottom-up stock selection, investors like us, is the sector can be a goldmine, where if we do our job well, we can pick, very attractive opportunities, which can be long-term wealth compounders. Move to the next one, please. This again just talking about the rich diversity and the wide spectrum of opportunities in the sector. This is just from an industry classification standpoint. If you look at consumer discretionary, it has various subgroups, right? From retailing to autos to consumer durables, apparel, consumer services, including food services, etc. Then healthcare, uh, recreation or entertainment, and even home improvement, specialty chemicals, paints, construction chemicals and all. But the underlying drivers, if you think about it on the right hand side, right? And some of these drivers may impact some of these subsectors more than the others, but the underlying drivers really are demographic changes, growth in incomes, household incomes, disposable income. Internet penetration has become an extremely important driver in this sector because it creates aspiration, right? Aspiration is very important to development of a consumer discretionary category. The overall financial tech ecosystem, think of the availability of easy financing for durables, right? That unleashes consumer certain consumer discretionary categories. And one of the recent trends, which is work from home, which is on its way down, but that has also had an impact on certain consumer discretionary companies, right? Moving to the next one. Yeah. Now, this is what we believe about the Indian consumer discretionary space. We believe it's a potential multi-decade growth opportunity. We are talking about 300 million households, 1.4 billion people. It's a lot of aspiration out there, right? And most of these households and consumers are at the beginning of their discretionary consumption cycle, which can go on for decades as long as income growth, plays out the way one is thinking or forecasting it to be. Because ultimately, consumer discretionary, and pardon me for using a loose word, but magic in consumer discretionary happens when three things come together: disposable income, aspirations, and access, right? Think about wireless broadband. It used to be a discretionary consumption item till a few years back, and the geo moment when it happened, right? Aspiration was already there. The pricing that Geo came out with, bridged the gap between or made the service more affordable. So in this case, the pricing came down to the income levels in some sense, right? In certain other categories, incomes grow to the quote unquote pricing of the good or service, right? And access improved significantly as pan India 4G networks were set up both by Jio, Airtel, and over time by Vodafone Idea as well. And the sort of explosion we saw in data volumes in India, right? We are talking about in the last 6 years, and I've compared June 22 quarter to June 16 because that was the quarter pre-Geo. The data volumes in India have grown 82 times. This is 108% CAGR, right? Of course, one can argue whether what kind of value growth for the sector this has resulted in, etc. But the more important point is this unleashed, a quote unquote consumer discretionary category, and these three things came together, right? Internet, as I said, has democratized aspirations, and with a lot of organized retailers as well as expanding significantly, and e-commerce companies serving pretty much all pin codes in the country, right? Even access to some extent is rapidly getting democratized, right? So it's all coming together in some sense. That said, right, a lot of these categories, because they're in nascent stage, require effective development from industry players, right? Category development is extremely important. The way some of these categories will shape up, right, depends on how well the players in that category, shape consumer behavior and try and bring this trioca, right, where magic happens together in some sense, right? Because it is as much a intra-category market share fight for companies as it is inter-category wallet share fight between categories, right? So that is also very critical. And category champions, what we've seen empirically in a lot of other markets, category development champions actually create massive long-term wealth for shareholders. Again, think of the most the highest market cap company in the world, Apple. They created a category, right, of smartphones, touchscreen smartphones in a way, and they've created multiple categories over time, right? The risk to all of this, right, is because if you think of aspirations, they're there. Access is improving. The risk is slower than expected growth in disposable income. That has to play out for this category to deliver on its promise over the long run. Move to the next one. This really is a representation. Again, we're looking at underlying drivers here. And, again, to be very clear, not trying to stereotype or generalize here, but the Indian consumer is changing. It is increasingly more aspirational, more expressive. There's just a comparison of a typical, right? Again, not trying to stereotype, but an average Gen Y pre-millennial, consumer to a Gen Z and millennial. The lifestyle is completely different, right? YOLO is the new term that is in vogue in the millennial generation. You only live once, so people are willing to consume early. One way to also think about this is if you were to think of, let's say, the QSR industry, the lifetime value of someone who was born in the last 15-20 years or who's yet to be born in this country, right? for someone, for the entire QSR industry. The lifetime value for the QSR industry of someone who's born today is significantly higher than someone who was born 10 years back or 20 years back. Right? He'll consume a lot more of food outside home, right, than he does inside home, right? So, and you can think of a similar framework for a lot of other categories, and the LTV of the new consumer, right, is or people who are going to enter the consumption class over the next few years is going to be significantly higher than the existing ones, right? And that's what will end up creating significant value in a lot of categories, right? Move to the next one. Just a few, core drivers here, right? And there are many, but we've just picked three. The first one that you see on the top left-hand side is really the income pyramid, if you will, in the country, which is going to move from pyramid to a diamond, right? And that's the base case expectation, that we are going to have a significantly larger, middle class in the country. The aspirant class or the struggler class is going to actually shrink in absolute terms and will become a much lower share of population, right, over time, right? The second one, as I said, internet, given the cost, how quickly the costs of internet access have gone down, you have had significant increase or jump in internet penetration, which has fueled aspirations, right? And the last one, of course, the young population of India, which was the last point I made. These three are the fundamental drivers. Again, you're talking about income, access, right? Internet also sort of improves access thanks to the e-commerce penetration in this country, the reach of e-commerce, and then of course aspirations, which is partly linked to the median age, which is fairly young in our country, right? So these are really the core underlying drivers. What you see on the next slide is how inflection in specific categories, and this again is a more generalized version of how things play out in an average country. India could be different, right? Because consumption patterns, right, tend to be very different, right? They're similar to some extent, and they also tend to be different in different countries. In fact, just as a matter of trivia, there are only two categories, large categories that where India's per capita consumption is actually, and on a per capita basis, consumption is higher than the world. And those two categories are gold and edible oil, right? Those are cultural nuances of various countries and that come to fore. But this is a very generalized view on which categories take off at various per capita levels, basis experience of other countries that have gone through this journey, right? And you'll see that a lot of consumer discretionary categories, see an inflection point as countries move through this per capita curve. India currently is at about $2,500. As we travel from this 2.5 to 3, 3.5, 4, 5, 6, and over time, hopefully reach much higher levels, a lot of these categories are going to see significant inflection, because ultimately what you see here is an aggregate of what a lot of individual households and consumers do, right? And if you think of a movement of an individual household from a particular income level to let's say 2x income level, right? Some of the categories that are already being consumed will not go up 2x. That higher disposable income will add categories to the consumption basket. And those tend to be more discretionary categories because staples is already being consumed, right? So that's really the message on this slide. Move to the next one. This again is, highlighting the low penetration of several categories in India. You look at branded apparel, much below, both China and US. We've just used these two as comparables. Food services, again, significantly below. Beverages consumption, significantly below, right? So to that extent, the opportunity for per capita consumption to go up, and hence overall aggregate consumption in some of these categories to go up is significant, right? Moving to the next one. Now, that said, we as I said, there is going to be a wide variation in the skew or very, very, wide skew in performance across companies, right? We've just taken an example from an illustration perspective from the apparel retail space and looked at, let's say, three different quote unquote sets of companies, if you will, right? This has been the right space. Overall branded apparel space has, organized space has grown, I think 40x in the last 20 years, right? Of a very small base. But there are companies who have executed well, companies that have not been able to execute well, and companies which have executed extremely poorly, right? If you look at the second column from the left, right, this is a company that has done extremely well, right? And from an illustration perspective, we've picked trend for this, right? The 10-year returns from the stock have been about 31% CAGR. The stock has gone up close to 15, 16 times. And if you look at some of the underlying metrics, right, they represent a well-run retailer, a very well-run retail operation. And there is a lot that has gone into creating what you see as the trend of today, right? The second, the middle column really is, from an illustration perspective, we picked an ABFRL, again, the same space, but they've made poor choices and their execution has actually been average, right? And the net result has been, while the stock has, delivered some returns, it has been subpar, below market returns. The stock is up about 3x in the last 10 years for about a 7% CAGR. And the last one really is spectacular failures that we've seen several of them in this space, right? Companies that have gone down and they've made very, very poor choices and run their operations extremely poorly, right? And all of them have gone bankrupt or end up being massive bill destroyers. The stock selection still remains key to returns given the wide skew that one will see in operational performance and financial discipline across various subsectors, right? Across companies in various subsectors. Moving to the next one. This again, these are global examples, and we picked examples to illustrate the point that value creation can happen across consumer discretionary categories, right? So you'll see, examples from something like Li-Ning, right, which is actually an athleisure footwear player in China, right? A local player which has competed with global players like Nike, Adidas, and all, and has still created significant value. You'll also see Anta in the list. These are two Chinese, sports and athleisure companies, right? Primarily footwear, but also into other sports and athleisure categories, right? So homegrown companies can compete well. That's one point we wanted to make on this one. The second name that you see is Lululemon, extremely niche category. This company started as a yoga pants company, but has gradually built on that core consumer promise and built its business into other categories, right? You'll also see Dino Polska, which is actually a small Polish retailer, right? A restoration hardware, which is actually a furniture company, right? A retailer, furniture retailer, Apple, Costco, these are well-known names. Hermes, LVMH in the luxury space, Motai, as I said, in the Alcobev space, Home Depot, right? In one of the most boring spaces, if you will, a home improvement retailer, right? Exceptional performance in the last 10 odd years, just a steady compounder, right? And you'll see McDonald's, right, which is the leading food services chain in the world. And all of these companies have outperformed, both the MSCI World Consumer Discretionary Index and the EM Consumer Discretionary, for companies where that is the relevant index, right, by a significant margin, because we are talking about 5 and 10-year returns here, right? So performance can happen across categories, right? But again, what we could have also shown is companies that have destroyed value in the same sectors, right? And there are a number of them. If you think of just the apparel retail space globally, right? While or let's say the lifestyle space, someone like a Nike has created value. There are many other companies who destroy a lot of value, right? Or take Costco, right, which is a retailer in the US. Several retailers have either gone down. Think of names like Sears, and an interesting phrase I read on Sears is that it is the slowest liquidation in the history of corporate America. Right? It continues to go down. The company hasn't gone bankrupt yet, but it continues to go down, right? So there are similar examples on the other side as well, and that's what makes stock selection extremely critical. Right? Move to the next one. And now the investable universe in India, right, has expanded significantly in this space. This is the number of consumer discretionary names in BSE 500. If you look at September 12, there were a total of 35 names, split roughly equally between autos and ex-autos or non-autos. If you look at it today, there are 71 names, and 43 out of these, close to 60%, is non-auto names, with several listings in several niche segments, right? Only in the past 2.5, 3 years, right? You look at names like Metro, Manyavar. When it comes to KFC, Pizza Hut, the two franchisees of Yum Brands in India, Restaurant Brands, which runs Burger King in India, EMIL, which is an electronics retailer, Go Colors in the fashion space, Campus again in the footwear space, Nykaa, the leading BPC, e-retailer in India, or let's call it leading BPC retailer now with their offline presence. Zomato, one of the food delivery companies in India, Barbecue Nation, again another casual dining company. So across several subcategories, you've seen very interesting names, companies that have a lot of promise, and we are invested in some of those, and we'll talk about one of those as a case study towards the end. Right? Move to the next one. Now, how do we evaluate consumer discretionary companies? Our basic framework of evaluating companies still remains the same. right? However, the specific tools, the specific metrics, techniques that we apply, right, to evaluate companies in the space could be different. And in the interest of time, I'm going to skip the details here. But what is most important really is, one, identifying what the business really is about. Is it a product brand or a retailer in the space, right? Paying equal attention to the front end as well as the back end, and most importantly, because this in this sector you can grow very fast, but the discipline from a financials perspective, when you're doing so, right, you can open, if a 50 store chain can open 100 stores by taking on debt. And you've seen a lot of companies go down because they try to grow too fast without having the necessary discipline and the backend infrastructure to be able to support that, right? So growth for the sake of it is what kills companies here. So disciplined growth is what we're looking for. From a financial discipline standpoint, there is a healthy trade-off between incremental ROIC and growth that companies need to strike from a financial standpoint, and that's what we look for. Move to the next one. These are just a couple of frameworks, because we look for great companies. So a couple of frameworks that we apply in this sector, and pardon the colors on this, we couldn't get better colors and make it a little prettier. But what this framework really is, an expectations delivery framework. What you see on the horizontal axis is the range of expectations from a consumer standpoint, and on the vertical axis is the delivery of various companies, right? So there are companies who deliver below consumer expectation, companies which deliver above consumer expectation, and in the middle there is a average zone. There's an above average and below average zone. The companies that are above that is what we call the zone of greatness, and companies below the below average zone is the zone of mediocrity, right? Companies, but the more important nuance is, even though this sector really is still being developed, as I said, a lot of categories are still being developed. You'll also see, this is not a static view is the point. It's a dynamic chart in some sense, because there are companies which are shaping expectations, right? They're actually creating new expectations, enhancing customer expectations, right? And if they continue to deliver above those enhanced expectations, that is when you create exceptional experience, what you see on the top right hand side. And then even from a value perspective, there are companies which are pushing limits on value. Think of a DMart, for example, right? That's when you start delivering exceptional value. So you can be a great company by picking the value end of consumer expectation, or you can be a great company in this space by picking the experience end of of consumer expectation, right? You can, but it's a K, right? K has become the favorite word in the last couple of years. There is, the middle is really where you don't want to be. You either offer exceptional value or offer exceptional experience in a way, right? And that's what leads to greatness over time, right? Let's move to the next slide, please. So the second, test for greatness that we look for is a single word, really, remarkability. Whether a consumer discretionary company or any company for that matter is a remarkable company or not. And this is especially true in the consumer discretionary B2C space. And by remarkability, what I really mean is the company, the company's customers, right, take the story or narrative of the company to other, potential customers, right? The company has to deliver a consumer experience that makes its customers, talk about the brand, talk about the company. How do you do this? You do this by delivering consumer delight as opposed to just customer satisfaction. The keyword here is really wow. What I really mean is good enough is no longer good enough. The company also has to deliver a very strong reason / purpose, and not just a strong what. So and really, if I were to capture this in short, right, this quote by Schopenhauer, a German philosopher in the 19th century, captures it very well. He says, talent hits a target that no one else can hit, whereas genius hits a target that no one else can see. Now, given the stage of evolution of the consumer discretionary sector in India, we are looking at companies that can shape categories, that can actually sort of not just deliver on express needs, but also unleash latent needs and hit targets that the customers or us as investors can't see, and end up surprising all of us positively. Let's move on to the next one. So what we have here is a couple of case studies of companies that we've invested in over time, and these are again what we believe are two remarkable companies, both in the apparel space but different subcategories. Jockey in the innerwear space and Manyavar in the men's ethnic wear, and increasingly the women's ethnic wear / wedding wear space. Absolutely remarkable companies. They've shaped their respective categories, executed brilliantly over years. and this reflects in significantly better than competition financial metrics, consistent growth. So all of this really, whatever we've discussed so far in terms of what makes a company remarkable, what makes a company great, exceptional, etc., sort of gets illustrated very well with these two examples. One of these is a recent listing, and this is what we mean by the increase in or opportunities that we as public market investors have in this space. Thank you very much, and over to you, Vivek.
Starting with you, Prashant, the first question is, there's some discussions around Europe +1 in addition to China +1. Just quick thoughts from you on the same.
Well, certainly there is this happening, because as you can imagine, there's a lot of certainty today in Europe. Certainty regarding not just the price of the fuel and energy that they can source, but the availability, because as they say, winter is coming and the demand from resident would shoot up. And depending on the severity of the winter, it can shoot up to different degrees. And so the companies have to plan. And if you are, for example, someone like say Bayer or BASF, who's producing the final product, or any pharmaceutical company or a chemical company who are producing the final product, they have to make sure the entire supply chain from the initial bulk drug to all the way to the final formulation is secured. And to the extent that, and Europe is a big manufacturer, as an example, of many of these chemicals. And I'm just taking this as one example. The same applies for very many different industries as well in manufacturing. So if at any stage a company making a particular intermediate step of the molecule, if they are not able to function because of lack of supply of gas or energy, and the gas is used as a feedstock also in many of these processes, besides being a source of energy, and then it would impact the production at the tail end of the final product. And hence, there is great degree of uncertainty. And so those who are producing the final product, or anyone who's getting inputs from other European companies, they are trying to figure alternative sources. And at this time, India is in a very good position. Obviously, all of that is not coming to India alone, but India is benefiting from that because China is having its own problems. So the first choice would not be China at this time. But if, yes, other places are not able to, then China is also going to benefit from Europe +1, even as China itself suffers from China +1. So net, yes, Europe +1 is very real, and we are hearing it from a lot of our companies as well.
Sure. Thanks, Prashant. Just staying with you, and a question on the IT sector. Maybe you can answer this. It's just quick views on the IT sector. Are we looking to, how are we looking at the sector, and any changes in the portfolio? Considering
I know we can't talk about specific. I know some questions had about specific names, but we can't really talk about too many specific names in the portfolio. Yes, there's a name in the portfolio that we've exited, but it's more company specific. We've made our money over time. It has been one of the big contributors to our performance. And we think at this time, given the set of challenges that they're facing and the valuation where it is, the money is better deployed elsewhere. Some of that can flow within the sector also to other names within the sector, and some can be outside the sector. So we have a very healthy allocation, as you might have seen in the presentation earlier, or I can just say, because in the interest of time, we have a close to double digit or just over double digit. The team has an allocation to the IT services sector, and particularly given that a lot of it is to mid-cap IT, right? So the effective exposure, if you will, the beta adjusted exposure that the team has still is higher than the benchmark. And we believe the names that we have are the ones that are structurally benefiting from all the mega trends that have been at play for last several decades in tech sector. And these are companies with very solid managements that are going to be affected. Every company is going to be affected by the downturn if globally there is a demand downturn. But these companies would out execute the competition and come out at the other end with a stronger market share than going in.
Sure, Prashant. So maybe coming to you, Rohit, and Prashant, you can also add just a lot of discussions around the defense sector. Just quick thoughts from you on that, Rohit.
So again, several opportunities as we look to sort of become more self-dependent, right? Again, we continue to look at it from a bottom-up standpoint. The big development is that the government is now open to higher private participation, and indigenization of technology from a defense perspective is a big push. So there will be opportunities in the sector driven by these two things, and we continue to evaluate a lot of companies in the space and have some exposure. Prashant, if you want to add.
Yeah, and just want to caveat to people, oftentimes, investors, retail investors, or even fund managers and media creates a lot of discussion around some themes. Yeah, and defense is one of the themes. Now, we as a team don't discard the ideas just because they've become a theme, but at the same time, we don't, invest in companies in that theme just because they've become a theme. Sometimes the best way to benefit from is by staying completely out of it. Yeah. Because maybe there are no good companies that really think, for example, telecom sector, if you think of wireless, there's tremendous growth from 2003, 4, 5 onwards, all the way till, a few years ago. But hardly any company created real value of any substance. A lot more money, a lot more wealth that was destructed, not just in India, but around the world. If you look at, be it in US, be it in Europe, be it in several of the emerging markets, be it in India, would say there are many more instances, and collectively there was more money destroyed, more wealth destroyed in one of the fastest growing sectors of our time. And that was a very strong theme at the turn of the century. I mean, I used to cover telecom sector in the US in the late 90s and early 2000. It was a very strong theme. Mobility, obviously, how can, everyone is going to have, and everyone does now have a mobile phone. So in the real world, what was projected did play out. But the dynamics of the industry were such that nobody could capture the opportunity. And so that's very important, whether in any theme that you look at, whether there would be players in the industry, investable ideas that would capture the opportunity. And in defense, yes, there are some. A lot of players are just riding the positive momentum in the stock market, but there are some that would capture value over time. And we do, as Rohit mentioned, we do have some investment in the portfolio in the defense sector.
Thanks, Rohit. Thanks, Prashant. Parag, coming to you, there's a question on insurance. There's been a slowdown in some of the general and life and numbers. Anything to worry about? Your quick thoughts on that?
No, see, Vivek, what happens is that industry do pass through a lot of business cycle, right? If you look at pre-COVID, all the insurance, especially life in terms of protection and all those stuff, were firing quite well. Post-COVID, what has happened is that the reinsurance market is tight, right? There are a lot of nuances which you have to go through before you take protection policy for that matter. Let's say a 25-year-old individual, even if he wants to take a life insurance policy, he has to take an ECG and all those stuff. So there has been some slowdown due to price hike, tighter procedures and all those stuff, but it is a part and parcel of any business cycle, right? As the things kind of come back to normalcy, again, you will see the business numbers on the insurance side doing very, very well. But we are very mindful of the fact that irrespective of business cycle, as a lot of our team members keep highlighting, the great companies, the good companies with a lot of brand value and etc. will definitely do very well across the business, across various business cycles. So we'll keep that in mind, and we are quite sure that our portfolio companies will do much better than the overall market conditions.
Sure. Thanks, Parag. Prashant, coming back to you, and this is a question which you've been answering and for many years now, as a number of stocks in the portfolio, just the rationale of having 50 plus stocks and your thoughts on that.
Well, thank you. And yes, Vivek, as you heard it more than anybody else, probably it's a question that I've answered a record number of times compared to any other question that I've received. And many on the call might have heard me answer that. So I'll try to keep it somewhat brief. But first and foremost, it's one of the biggest myths. There are many myths in the investment world, and this is one of the biggest myths that's been perpetrated by experts of the highest order as well around the world, and not so experts as well, that a concentrated portfolio leads to a stronger performance. My firm belief always has been, particularly in case of India, if you are managing any material amount of money, which you would if you are to have a strong investment team, like the one we have and any of the other top players might have, then having a larger number of names allows you to provides the opportunity to generate higher alpha than having a very fewer number of names. In the name of, I think of these more as marketing gimmicks, like focused portfolio, concentrated portfolio, super focused portfolio, so on and so forth. Managers unnecessarily handcuff themselves with such constraints in a game that is already very competitive. I give this as an example, a cricketing analogy. It's like playing cricket with handcuffs on. You'll still be able to take catches, but only a few of them, and miss out quite a lot of them. Having no constraint on number of names allows us to go lower down the market cap range. And if we look at our top, if any of you recollect, one of the top contributors was Naveen Fluorine in our list. We invested in Naveen Fluorine when it was about 5,000 crores in market cap. Today it's 25,000 crore market cap. If any manager managing 10,000 crores or 20,000 crores of AUM, let's take 20,000 crores of AUM, and having a 20 name portfolio, at a minimum they'll have to invest 1,000 crores if it is average position size. You can't invest 1,000 crore in a 5,000 crore company. To invest 1,000 crore, you'll need at least a 15,000 crore, 20,000 crore market cap company for towards the lower end. And so you will be effectively ruling out the entire small cap segment of the market, and only the upper mid caps or the upper mid caps and large caps is what you'll restrict yourself to. So you'll basically restrict yourself to 100 to 150 names in the investable universe, which is what a lot of other players who have similar constraints, self-imposed or otherwise, on the number of names would be having. So everyone's then fishing in that small pool, which is okay if you have a small team of 2, 3, 4 decision makers. We have a very large, well-resourced team, which has been built keeping in mind our performance first culture, if you will, and the goal to generate highest return, for which you have to go down the market cap spectrum also to find great opportunities. And for that, you have to have the flexibility to own larger number of names. So if you can't buy a 4 or 5% position in a name, you can buy a 1% position and buy 4 such names or 5 such names, rather than ruling out all these 4 or 5 names. And there are several names. Naveen is one, Dixon is another, Coforge is another. These are names which we had bought when they were sub 10,000 crore market cap, which if we had these artificial constraints, and those who have such artificial constraints often are not able to buy until they're much larger. So I'll pause there in the interest of time.
Certainly, Prashant, thanks. Quickly, Rohit, coming to you, there's a question on the digital leaders portfolio. Just wanted to hear your thoughts on how the portfolio is constructed and likely to be constructed in the next few quarters.
So construct is, really we're looking at beyond the pure digital names. We're looking at, 2 or 3 different types of companies. One is, companies that are a part of the emerging internet ecosystem, whether it is consumer tech, fintech, insurtech, right? That's one. Second, we're looking at, incumbents in, let's call it, old economy industries, if you will, or non-internet sectors, which are leveraging technology to leapfrog, ahead of the competition, right? So technology is now at the center of most businesses. It has moved from being, a pure cost center or a driver of just cost efficiency to actually, at the consumer facing end and increasingly becoming a differentiator, right? So to that extent, we're looking for companies who are leveraging technology well across sectors to distance themselves from competition, and then we're also looking for companies that are at the forefront of innovation, and lastly, companies who are building infrastructure for this digital economy, if you will, right? So there are 3 or 4 different types of companies, and so to that extent, we have kept this a broader, sort of set of companies that we're looking at. Number one. Number two, partly again, Prashant spoke about constraints, right? If we were to constrain ourselves to just the pure quote unquote, what is defined as the internet part of the market, right? The number of opportunities available at this stage of where the market is, right? In India, in the public space, is limited, right? You'll end up, fishing in a much smaller pond, if you will, and be forced to take decisions that you don't want to take, right? So to that extent, the digital leader, thought process as far as portfolio construction is concerned remains the same. We continue to believe that there are going to be significant opportunities to generate alpha in this sector over the next many years. Prashant, if you want to add anything.
I think you covered it well, Rohit.
Sure. Thanks, Rohit. So Prashant, coming back to you, there's a question on Indian markets relative versus the global markets, emerging markets. Your views about that over the next few years, and of course, a related question to that is, given that we've seen a lot of FIs withdrawing money this year, and given all the positive commentary about India, reasons why FI is exiting. If you could just speak about that.
Certainly. So just the latter first. So basically, globally, there's a lot of uncertainty, as you all know. Uncertainty regarding Russia-Ukraine war, uncertainty, and a lot of these are tied to each other as well. Like inflation pressure is in considerable part due to the Russia-Ukraine war. It's also because of the COVID lockdown situations in China, some of it. So there is this Russia-Ukraine war, COVID lockdown situation in China, inflation in the developed world at high single-digit level, something that they've never, in a long time, in 2 generations nearly, they've not seen. And so this has created an environment where there are a lot of outflows from equities in general. Not just emerging market equities, but equities in general, but yes, also including emerging markets. Now, bulk of the money that is invested in India is invested through non-India dedicated funds. So we see the FII money, I mean, we all see these numbers in media that $750 billion is invested in India by foreigners, or 700 billion now, something in that range, right? It is not that these foreigners are buying India dedicated funds, like you all here on the call have invested in an India portfolio. It's not that this $700 plus billion is an India portfolio. Some of it is, but it's maybe only 20 to 25%. Nobody has a clear number. In our assessment and what we've seen suggests that only 20-25% is India dedicated portfolio money. Yeah. And like, for example, we manage nearly $4 billion of that as amongst the largest managers of foreign investors' money into dedicated India portfolios. But a lot of the money comes as part of a global emerging market fund, where 15 to 20% is invested in India because the benchmark weight is now 16%. Or it comes as part of Asia portfolio, or it comes as part of a global equity portfolio. And that is the giant lion's share, 70-80% of the money. So now when equity outflows happen from EM and global equity funds, they are forced to sell across board. Even if they like India, they are forced to sell to that degree. And that is where, in our assessment, bulk of the outflows are. FIIs have not invested India specific. I don't believe, again, it's difficult to say for surety, at least what we are saying in terms of flows to our funds and interest from our prospective clients as well as existing clients. I think there is in fact an increased interest in India dedicated investments, but the outflows are happening more from the the multi-regional funds like global equity, EM equity, international equity, so on and so forth. And that being the largest bucket investing in India, that's why the numbers might be negative.
Sure.
The other portion, how do we, the other question was, Vivek, please repeat.
The Indian equity markets relative to global markets and emerging markets for the next few years.
Certainly, see, from a return perspective, at any point in time, it's reasonable to expect ex ante that going forward, all these markets are going to deliver same or very similar returns on a dollar basis. If you look at the last 20 years or since the turn of the century, since the year end of year 2000 or end of year 99, US has delivered 5% dollar return. EM has delivered 5% or thereabouts dollar return. And India has delivered a 6% dollar return, because this year India has outperformed considerably, and so 1% higher. Yeah. But if you were to look at as of end of last year, probably it will be all 5, 5, 5 or somewhere around there in terms of return of 5 to 6% return. So, and these are all in dollar terms. And I think that's reasonable, and that is logical that going forward also one should expect individual countries and markets to return in their local currencies returns equivalent to their nominal GDP plus the dividend yield. Yeah. And in India, we expect that to translate to a mid-single digit dollar return, 5 to 6%, and expect similar returns from developed world as well as EM world. Investing beyond India does make sense, though, to get the diversification benefit, because if you look at, like I was saying, last first decade, so 2000 to 2010, India outperformed dramatically compared to, say, US by about 10 percentage points or so. And then the next decade, from 2010 to 2020, India underperformed terribly, underperforming by 10% or so in dollar terms. Yeah, though over a 20-year period, both returned about 5 to 6% return. So if you were to spread a little bit, diversify a little bit, that would have given you more consistent return. Similar, at least the market return would have been similar. It remains to be seen whether you can, obviously you have to find, in my view, it's alpha can add a lot of value in India. And so you have to find similarly strong manager for outside India as well to be able to, deliver strong total return. In India, alpha potential is higher than most other, especially the developed world. India is alpha potential is higher, so that you have to factor in. But there is merit in some diversification across global equity markets.
Sure. Thanks, Prashant. Maybe we'll just have time for one last question, given it's already past 6:15. And maybe coming back closer to home, Prashant, maybe quick comment from you on the corporate earnings this quarter and the expectations in the next few quarters to come.
So corporate earnings are in India fairly robust. Obviously, globally, they're expected to weaken, and there would be some effect of that. So there are countervailing effects in India. If the global demand environment is to slow down considerably, then it would hurt the earnings projections for export-oriented sector like IT services, engineering exports, and so on. But just by the way, having said all that, I want to be clear, it's not that you can make money by such projections, because market's already expecting a substantial slowdown. Yeah. So in fact, a slowdown can occur for IT services, and yet the IT services stocks might do extremely well because the market's looking beyond the slowdown. It's like, in March 2020, if you were in March 2020 and you were to know how badly COVID is going to impact the livelihoods and lives of people around the world with all the lockdowns and still lockdowns going around the world, you'll believe the stock market would go nowhere but down. Yeah. But market discounted all that in March 2020 and had one of the best runs over the next couple of years. So just because what I'm saying, this global export-oriented sectors can suffer in corporate earnings doesn't mean that the stock prices cannot do very well for some of these sectors or stock specific individually. And we do continue to, I saw several questions to this regard, we do continue to have a very strong exposure and investments in IT services sector as well. So we don't take such top-down sectoral calls, but are more company-specific. But having said that, the export-oriented companies, if the global slowdown is acute because of the war situation or the inflation situation and all, then they would be more hurt. But domestically, India is better positioned because of several factors, including the Europe +1, China +1 that we talked about. And you have to go sector by sector. Banking sector, which makes up 30% of the benchmark, has never been in better shape in terms of earnings growth. Their balance sheet are extremely clean after nearly a decade of write-offs. I'm talking collectively as a sector, including the government-owned banks, and after over-provisioning for COVID. So 30% of the benchmark or market might deliver close to 20% earnings growth from here. IT sector, which is one we already spoke about, that's about 10% of the market. Consumption sector, there are countervailing forces. There would be, if inflation were to spike in India further from right now in mid to high single digits, comfortable for India. But if it were to, which is not expected, were to go much higher and causes a slowdown in the economy, then there could be some impact on consumption. But otherwise, it's reasonable to assume a low teens kind of growth in the consumption sector as well. And capital spending is picking up after a long time, because of a lot of manufacturing is moving to India, and the Indian domestic economy itself is doing well. Then capex, after a lull of nearly a decade, is picking up. So the industrial space, be defense, as we spoke about, or other segments of industrial space, the earnings growth trajectory is expected to be very strong, double digit, north of 20%. So on the whole, expectation are for about mid-teens, call it 15% earnings growth over the next few years, which is not dramatically different from the longer term average of about 12%.
Great, Prashant. Thank you so much for that. And thanks, Parag, and thanks, Rohit. We've come to the end of the webinar. And thanks again for taking time and joining us. We look forward to meeting you again next quarter.
Thank you. Thank you all for joining, and thanks for the patience and staying with us till now. Thank you.
Thank you.
Thank you, everyone.